If you use Fibonacci's, but you've been confused about what they mean and how to use them, in this video, I'm going to be giving you guys a quick breakdown of what a Fibonacci retracement means and how you can use it for your next set of trades. So when it comes to using a Fibonacci, we first have to break down what the definition is and the use of it. Fibonacci is basically a sequence of pattern numbers. Basically, if you were to look at stairs, and I like to use the stairs as an analogy, stairs are equal. It's like an equal distance. And if a stair is off by by a step or an inch or whatever the case may be, you may fall, right? So it involves mathematics. And it's the same thing that we do in life. We have a sequence of numbers that have a flow, a pattern, if you may. And so an example could be 0 plus 1 equals 1, 1 plus 2 equals 3, 2 plus 3 equals 5, 3 plus 5 equals 8. And basically means if you take the last two numbers and you add them together, the numbers extend or carry on to the next set of numbers. So it's increasing like a flow or steps, if you may. So that's what can be said here for Fibonacci's. If you take a number, or if price goes to one number in sequence, it should extend to the next. Now, if we can relate this to the forex market, it just basically means that as price flows up and down, up and down, up and down, if price retraces or after it retraces, it rejects or bounces off of a particular number, it should extend to another number. Now, that's one of the ways in which you can say this, or if you simply put it, we can say it like this. As price is flowing, when it pulls back, the retracement or the Fibonacci retracement tool just measures how deep price can pull back. That's basically it. So we're going to use this illustration here, okay? So just keep in mind the Fibonacci retracement. Retracement means pullback. The Fibonacci just measures how deep price will pull back before it extends or it continues on in the trend continuation cycle, meaning price is just pushing up. You can even call this an impulse move too. That's what people call it. So, what I want you guys to understand is that when it comes to your strategy, your structure matters first. You first need to identify where would you want to enter a trade. That is always first. That is your foundation of trading. You cannot use a Fibonacci first. That is one of the worst things you can do as a trader, to say, "Oh, well, I think price could come to the 38.2 or the 50, or what people will call the golden Fibonacci, the 61.8 or the 78 or the 88." What we don't want to do is guess what level one of these could be rejected at for price. What you want to do instead is say, hey, this is the trend that I see. This is where I would enter the trade. Now, since I know where I want to enter the trade, this is how far price can pull back by measuring it by the Fibonacci tool. So let me give you guys an example. So this is on an exotic currency pair. This is past market movement, and this is what we're going to be back testing. Because in order to see how this works, you need to first understand that any level can be rejected. Like price can come to any of these levels and push off of it. But that's not what's most important. What's most important is the first, you need to be in the trade. You want to know where you're going to enter the trade at. So here's an example of how I trade with my supply and demand system. First, trend. I want to know where price can pull back to or retrace to. So let's just say here, with this particular exotic, price was up here at 391, and then I'm saying, hey, I think price can pull back to 378. But this, my estimation zone, where I'm estimating where I want price can go, this can be where I see, or I'm going to wait for price to see if it can pull back. So my structure, or your market structure, aka the exchange rate at which you will enter the trade, that is important. This is the foundation, right? So I have yet to put a Fibonacci on here because I first want to await to see if I have an entry. That is number one. So I'm going to play this forward. Now, I also want to say that it is okay if you use something different. You may use trend lines. You may use support and resistance. You may use order blocks. Whatever it is that you use, just remember that your market structure is personal to you. Choose one. Maybe you have two, but that one or two is where you plan to enter. That's it. And everyone here is different. It's okay if you use something different, okay? Some of you may say, well, Shaquan, I see if I'm using support and resistance, maybe you're going to use the higher high and you're going to say, well, Shaquan, I believe price can come here and then continue back up, which is perfectly fine, right? But I'm yet to going to use that Fibonacci retracement tool. For me, I need price to continue to pull back a little bit deeper. Okay, so let's just say price does touch my estimation zone. I like this spinning bottom candlestick. I want to enter the trade. So at this point in time, what I'm also going to do before I even pull out this tool is say, where is my exit point? Now, for me, my exit point is, let's just say it's at the higher high, back up to here. Okay, great. So I know where I'm going to exit. Stop losses are personal to everybody, but let's just say I put my stop loss back down here to the low. So now I have my exit point. I'm going to put a green arrow. Now for take profit, I have my other exit point. For my stop loss, I'm going to put a red arrow. And all I'm saying is, hey, I know my entry. I probably will have more than a one-to-one risk to reward on here, and that is great. So number one is your structure matters first. Two, what we're going to look at with the Fibonacci retracement is this. The deeper the pullback, the more profit you'll gain. Because the deeper price keeps passing these levels, when it does go back up in an uptrend or down in a downtrend, the more price has to recover to get back to your profit area. Okay, so it's not about price just rejecting any of these levels. It's about where you enter first and how far price has to pull back to get to that position. So let's just say here, I'm going to use the field this time, placing my field from the higher low to the higher high here. I can say, okay, well, it looks like price is you give it a deeper retracement, and the deeper it goes, and I would say this, it because normally people have a 23.6 here, I believe. I don't use a 23.6. To me, the risk reward on some trades may not be worth it, but I know that the deeper price has to pull back, as long as it does not pass my stop loss or where I want to exit the trade if I lose. The deeper it pulls back past the 61.8%, the further it has to travel, I may actually make more money. Okay, now let's just say that it did get to, let's say, the 61.8. Then that's like a mid-range pullback. Or if it got to the 50 or the 38.2, that's a smaller pullback. And what this means, let's talk about probability. Okay, because the second step of this is your probability. If it pulls back, not really steep, but just a little bit, what this means is, one, it's going to hit my profit target quickly, very, 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 very quickly. And the deeper it pulls back, what this also means is that it's going to take a little bit more for it to reach my profit target, but I could make more money depending on the stop loss as well, depending on where I place that stop. And that is important as well too. Okay. So that's number one. So let's just say I enter the trade here based on it touching my zone and giving me a spinning bottom here. Okay, great. Now we're going to go to number three and what the Fibonacci actually represents in this case. Some people would say, well, and notice that I mentioned that I said I'll exit at the previous high. Some people will say, well, I'll exit at the 0.00. Now what you're doing is you separated the Fibonacci and the actual trend cycle of the uptrend, which is the higher high. And some people treat those as two different things. They are the same. It is not separate. So what you want to do is be careful with what you speak. The 0.00 was one of the starting points or the ending point in which you drew your Fibonacci at if you're going back to the high. Or if you're using it in a downtrend, it will be your lower low. So all you're basically saying is, I'm going to exit my trade at the high or the higher high or at the lower low. So just be careful when you're stating these. Okay. Now, the negative 27 extension is trend continuation. And what this means is some people will actually have an extended target. I know I do, to the negative 27 here, or yours may say negative 0.27. Same numbers, it's just different decimal places. Math classes, okay? It's just different decimal places, same numbers, okay? And what you're basically saying is, this is trend continuation. This is where I believe the extension, or where price can extend to create a new higher high. It doesn't mean that price will stop there, but it could be an extra extended target Or it could give you an option if you don't have a one-to-one going back up to your previous higher high for a take profit. You could just take one profit here to say, hey, I believe because we're in an uptrend or a downtrend, price would decrease or increase to the negative 27. All right. So I want you all to remember that. Now, one thing that I've stopped doing is using levels in between. And so all this means is I've taken off my levels. And here's one of the reasons why I don't trade with levels in between anymore. Number one, I have seen when some people get so caught up on levels, and I'm not saying that they don't work. What I am saying is sometimes you get caught up on levels, you forget where you even want to enter the trade. This becomes invalid where your market structure is the foundation, is the key piece of where you want to enter the trade. And so if you're having a hard time with distinguishing between both, and if you know you can still use this as a confluence, what I would say is use the levels last, but just remember that your entry is where you've placed your structure. Once you got that, once you have the take profit, once you have the stop loss, then just say, now I can use the Fibonacci to measure how deep the pullback is. Once I understand if I have a one-to-one, if I have more than a one-to-one, great. I can still use the Fibonacci tool to give me an extra entry to my extended target. Because if you ever use a Fibonacci expansion or extension tool, it has the negative 27 on there. I just took that and placed it on my Fibonacci retracement tool. It is literally the same measurement. That's it. Okay. And so I'm praying that this helps you guys when you're using your Fibonacci. Now, y'all may ask if I trade in between the levels. No, I just use the tool for what it is. I don't use it for support or resistance. I'm not using it to trade in between the lines. I'm using it to just measure how deep price can pull back, because I also want to know and get a gathering of where my ascending target can come to and what my probability actually looks like. Is it a deeper pullback? Is it a narrower pullback? What is it? Okay. So I'm praying that this helps. I really do. Okay. If you have any questions or any value to add, please do. Please add. Or if you have any questions or takeaways, or if you like the video, give it a thumbs up and let me know what you liked about it. I love the feedback. It inspires me to make more content like this, because this is something that I do teach my clients. Like, hey, this, if you don't have that one-to-one, you don't have to stay out of the trade. Here's what you can do, and here's why. And here's how. Now, here's how we can make it better, because that's what it's about. So I pray that this helps you all. And I'm going to show you guys how this actually panned out as well. This is how the trade panned out. Okay. And so if this is something that inspired you, please let me know.